Venture debt is a form of debt financing provided to early-stage or growth-stage companies, particularly in the technology and startup sectors. Unlike traditional bank loans, venture debt is often offered by specialized venture debt firms or banks with a focus on the startup ecosystem. It is used by companies to complement equity financing and extend their runway without diluting ownership. Key features and characteristics of venture debt include: purpose. Venture debt is typically used by startups and high-growth companies to raise additional capital alongside equity financing. It is often used to fund specific initiatives, such as research and development, expansion, or working capital. Collateral. Unlike traditional loans, venture debt may be unsecured or secured by specific assets, such as intellectual property, equipment, or accounts receivable. The level of collateral depends on the creditworthiness and stage of the company. Interest rates and terms. Venture debt usually comes with higher interest rates compared to traditional loans. The interest rates are often structured as a combination of a fixed interest rate and warrants, options to purchase equity, to compensate the lender for the higher risk associated with lending to early-stage or high-growth companies. The terms of venture debt are generally more flexible than traditional loans. Warrants or equity kickers. In addition to interest payments, lenders of venture debt often receive warrants or equity kickers. These are options that allow the lender to purchase shares of the borrower's stock at a predetermined price. This provides the lender with the potential for additional returns if the company performs well. Risk and return profile. Venture debt is considered a riskier form of lending compared to traditional loans, given that it is extended to companies that may not have significant operating history or proven cash flow. However, the higher risk is often compensated by the potential for higher returns, especially if the borrower's valuation increases over time. Complementary to equity financing. Venture debt is commonly used in conjunction with equity financing rounds. It allows companies to leverage their equity capital, extend their runway, and delay the need for additional equity fundraising. Use cases. Companies may use venture debt for various purposes, including financing working capital, funding capital expenditures, supporting product development, and navigating the period between equity financing rounds. Investor relationships. Venture debt providers may include specialized venture debt funds, banks, and other financial institutions. These lenders often understand the dynamics of the startup ecosystem and work closely with venture-backed companies. Venture debt is not suitable for all companies, and its appropriateness depends on the specific needs and financial circumstances of the borrower. While it provides an alternative financing option to startups, it's important for companies to carefully evaluate the terms, costs, and implications of venture debt and consider how it fits into their overall capital structure. As with any form of financing, thorough due diligence and legal advice are essential for both borrowers and lenders involved in venture debt transactions.